Well, hello everyone, and welcome to the Forbes Mazars Economics Hub presentation of our Tariff Special Economy and Investment webinar, coming hot on the heels of a webinar we did at the start of the month. But obviously, a lot has happened since then, so we're here to provide you a bit of an update. As always, I'm Ben Seager-Scott, Chief Investment Officer, and I'm joined by George Lagarias, our Chief Economist. I think just in terms of running order, if we go to the next slide, please, Leona. The agenda today, I'll do a little bit of framing, but then we'll go straight into the economics and talk about the tariffs, the trade wars, whatever we want to call them at the moment. That's going to be about 20 minutes long, and then we'll have a Q&A session to focus on the economic side, then to break up the flow of the presentation. Then after that, we'll switch gears slightly. We'll talk about markets and portfolios. We'll spend about 10 minutes on that because we've spent a lot of time on that at the start of the month, but just to update you on some of the changes that we've made most recently, and then we'll wrap up, we'll conclude and have the markets and portfolio Q&A session at the end there. So I said I'd start with a little introduction and a bit of framing. So if we can go to the next slide, please. This is going to be the introduction, and the next one again has the sort of meat. Just to frame at a very high level, the key themes that we're trying to focus around really are on screen. And I'd say these are the takeaways, and please do bear these in mind as we go through the presentation. First and foremost, it's important to keep calm, stay informed, and make measured responses and decisions in response to what is happening in the world. I would advocate trying not to focus too much on individual announcements, which are alternately announced and then delayed, suspended, waivers applied, or indeed implemented. But for us, it's more important to focus on the underlying common themes and some of the incentives driving behaviours. And in George's section, we'll highlight how actually tariffs and trade wars are something we've been thinking about for many years. There's quite a lot of historical framing we can use around this, and that helps inform our thinking process today. And George will we'll talk about how those thoughts can help us to analyse what's happening in the world today. And then secondly, I think business resilience is really going to be key. Our sort of outlook from here, all of the indications are that the sort of embargo level trade tariffs that are in place are probably going to modify. But the outlook is ultimately that the next 12 months and beyond are probably going to be a tougher global economic environment than they were 12 months ago. But rather than being in magnitude in terms of the size of those tariffs, it's likely to be more complicated, more targeted tariffs on specific sectors and specific products, more non-tariff barriers and other elements. So it's going to be complicated, and business resilience is going to be really important. And then finally, and perhaps more positively, it's important to look for opportunities. As we said, we take a probability weighted view of the world, and of all of those different outcomes, our base case is that short-term agreements will be reached, but that's going to allow the US to focus on its medium and long-term strategic competition with China. And that is a key theme that we think is going to persist. And whilst that is going to create disruption and challenges in some parts of the markets, it's likely to create opportunities for those that can focus on their own business competitive advantage and other opportunities that arrive from that dislocation. So being able to respond and be nimble is going to be really important. If we go on to the next slide, please, Leona. What we're going to talk about today is a very high level and very simplistic view of all of the work we've done in this area. If you do want to see some more of our thinking, there's a couple of publicly available resources that you can access for free. One is the Tariffs Hub website. That's on our website. The link is here, and we can share the slides afterwards. But if you just go to the Forbes Mazars UK homepage, there is a link from the homepage to our Tariffs Hub website. You can also see our Chief Economist's weekly newsletter. It's an excellent newsletter, highly worth reading every week, I would say. I certainly do, and it tees you up on the key things you need to know in the week ahead. That's called the Weekly Fears and Flows newsletter. You can get it via LinkedIn. So if you go on LinkedIn, follow or find George Lagarias and subscribe to the Weekly Fears and Flows, you can get George's views sent to you every week. And so with that sort of teeing up, I'll hand over to George to really talk about the economic details of tariffs and the trade war. So, George, over to you.
Thank you very much, Ben. If we can go to the first slide, please. Um, okay, so what's the big thing? The big thing is that the US is attempting to turn itself into essentially a fortress economy. It is attempting to shield itself from imports of a lot of goods in an effort to rekindle its own manufacturing and internal capabilities. Now, the numbers are astonishing. Um, Presently, we are discussing the possibility, fully implemented, of a 22.5% tariff in all imports or on average anyway, on goods entering the US. That would be a number that is unsustainable and would bring the US back to 1909 levels, where, by the way, goods at that point in time were mostly, simple goods. They were clothes, they were, wool and cotton. They were not the very sophisticated devices that we have today. Your car is not a car anymore. It's a computer. Okay, it has 30,000 parts and the brain essentially. And your phone is a supercomputer. And it's manufactured in 43 different countries. So the point is that this becomes extremely unsustainable because of the complexities of modern supply chains. At 22.5% tariffs is a very big number that's not really sustainable. Which, as Ben told you before, is why we believe that a lot of this is a negotiating tactic. Simply because fully implemented, it's not a number that can sustain, an economy can sustain over the longer term. Even if 10% tariffs are in the end imposed, as the U.S. president often alludes to, this would still bring us back to 1944, essentially, or 1946, essentially, right after the end of World War II. And again, we're talking about a number that's not highly sustainable. Definitely less severe than the 22.5, but the 10% is really not that a sustainable number. So keep that in mind because tariffs are a big thing, and also their impact is very big. Even the threat of their imposition is very big because you understand if something is so unsustainable and you have a small business um, or a large business, you're wondering, okay, so how do I find alternative suppliers? Do can I continue to run my business this way? Will it still be profitable? Do I need to lay off people? These are the concerns of every business owner, not just in the US, but also in countries that are somehow affected by what's happening in the US, which is essentially most businesses around the world. Next slide, please. Now, let's put this a little bit in a historical context, because I think there is merit to that. Um, it's all happened before. Okay. And that at the very least allows us to have a view on how things may turn out. So the system was first set around 1944, just before the end of World War II. The Western powers gathered in Bretton Woods. The dollar was collapsing at the time, and they created a system where they linked all dollars to gold and every other currency to the dollar, and that was known as the Bretton Woods system of stable currencies. It lasted until about 1971. Richard Nixon saw that the debt burden was very high and said, "Well, I can't deal with that, so I'll just print dollars." No matter how much gold I have. And he essentially broke the Bretton Woods system, ushering an era of monetarism and floating exchange rates. Um, Now, this was the first attempt by a US president to reset the system. Okay, it did not go so well. The 70s were a period that the economy was mired in with very low growth, very high inflation. And they were one of the worst periods in modern economic history. And this lasted well into 1982, 1983. leaving many parts of the economy devastated. So in 1985, another Republican US president, Ronald Reagan, attempts to reset the system again. And they say, okay, we need to devalue the dollar to get our manufacturing started again. So that was the Plaza Accord. In essence, they forced Japan and West Germany, and to a lesser extent France and the UK, to accept massive U.S. devaluation to get the economy started. It didn't also didn't work out so well. By 1987, they could not keep the dollar from collapsing. So they did the Louvre Accord, which tried to stabilize the dollar. Still didn't work because 7 or 8 months later, this happened in February. By the end of the year, the U.S. stock market experienced its worst day in history, even to this day, the Black Monday in 1987, with many repercussions going forward. But they got lucky. Those same economic forces, in essence, toppled the Soviet Union. The Soviet Union was out trying to open its economy at the time, and it took a lot of flack from the instability in Western finances. Okay, so by 1991 it collapses, and then all of the all of the world to the east, where two-thirds of the world live, was now open to provide goods to the American consumer. And also at that point, we get the internet, which gives access, direct access, to Europeans and to Americans to go in Asia and shop freely. And they said, okay, fine, the system is not working. So what you need to do is just need to lower tariffs so we can import cheaply from these countries. And bingo, you have globalization. Okay, by 2000, the hallmark of globalization, China entered the World Trade Organization. But still, that wasn't quite enough growth. Remember, trying to reset the system again and again did cause problems. So by 2008, um, there was another crisis because the only way to keep growth going was essentially through credit. So let the banks print money and give it to clients. That's what the banks do. They take your deposit, you keep the deposit, but they create new money out of it. And you have the global financial crisis in 2008, and then you get again sluggish growth, very sluggish growth for the next few years, and also growth that was uneven because the Fed kept rates very low and essentially was printing money. A lot of investments went to Wall Street rather than Main Street. So you saw asset prices soaring, and Main Street was really just trying to survive. Okay, so again, the system is not working. The pandemic accelerated its well, I wouldn't say downfall, but definitely it accelerated the manifestation of problems. So by 2025, we have yet a third attempt by a US president to reset the system. The tariffs are not the objective. The objective is to get manufacturing restarted and to get some growth from somewhere because the electorate is not happy again with the American electorate is not happy again with the growth that they have. Okay, and they figure that a significantly weakened dollar can help them with that. Okay, so this is the third attempt by a US president to reset the system, and the two before did not go quite so well. So please keep that in mind. Next slide, please. Um, so this simply reinforces what we just said. After the global financial crisis, global growth had slowed. Okay, from 3.6 before to 3.4 in terms of global GDP, but that was because China was keeping it up. And in the US, from 2.8 to 2.4%. Okay, still much better than Europe, which saw growth just north of 1%. So America has a growth problem. And if you have a growth problem and you impose tariffs, actually, probably you're making it worse. Um, and more to that point, next slide, please. Um, by saying tariffs, essentially, what do you acknowledge? You acknowledge that you have a growth problem, but you say, no, don't have a growth problem. It's a competition problem. However, that's not exactly the case. In 1990, the US was responsible for 27.7% of global GDP. China with just 1%, 1.7. By 2024, the US was responsible for 26% of global GDP, so they're just 2 points less. And China was responsible for nearly 17% of global GDP. Okay, so despite all the rhetoric, China is not taking America's share of global GDP. It's probably taking Europe's share of global GDP. What the US is more afraid of is not China taking a share, rather China growing its number beyond the 26, 28, 27, 28%, because that would make it the de facto global economic superpower. Okay, and this is what's really happening here. This is an economic competition and a system competition, the likes of which probably we saw in the Cold War. This one is just a lot more economic in nature. It doesn't involve a Cuban Missile Crisis, yet at least. Next slide, please. So, when all is said and done, tariffs will hurt growth, especially in the US. According to Bloomberg economists polled by Bloomberg, U.S. growth is slated to fall from 2.2 to 1.4% this year. The original estimate was 2.2 3 months ago. Now it's nearly half that, 1.4%. And inflation is set to grow. Markets expected 2.6% inflation, and now the expectation is 3.2% inflation. These are big moves for 3 months. The UK looks at similar numbers. Growth is slated to fall from 1.3 to 0.9%, and inflation is set to climb from 2.6, which was the previous estimate, to 3.1%. Well, the UK isn't imposing tariffs anywhere in the world, so why is it suffering the same fate? Because it has a more open economy, so it's more sensitive to the changes in global trade. And it's also more sensitive to global supply chain. So make no mistake, this is a global problem, but because the UK is one of the top 10 most open economies in the world, it is also catching some of that flack. So keep that in mind, that what's happening out there obviously affects the UK economy very directly. Next slide, please. So just to recap, what are we seeing? Slower growth across the board, higher inflation in the US and possibly in the UK. There's a caveat here. If it turns out that the US goes into recession, probably we won't see inflation, because recessions are not typically inflationary. Um, and on the other hand, we see lower inflation in Europe. Why? Because growth is sluggish, because China is lowering prices and they need somebody somewhere to sell their goods cheaply. Now, again, what may mitigate this is some sort of bottom-up business action. So, for example, the Sony decided to up the price for their PlayStation by 25% across the world, to be able to compensate for the loss they think they will incur in the US. So, theoretically, inflation in Europe could go down, but you never know how businesses might react, or consumers. So our inflation calls are very, very low. We have very, very low confidence in those calls. We think we're more confident saying growth will slow down, but as to how inflation will behave, we do have, a notion. But again, no one can be very confident. Inflation is a very big wild card right now. Unemployment might tick up if growth slows down, especially if it slows down precipitously. And we also expect more capital expenditure from companies, reducing margins, by the way, because supply chains need to be reordered, and the world is becoming more fractious. Next slide, please. Now, the bigger picture here is that we have a world with a lot of debt. And why is this important? Global debt to GDP is it is nearly 330%. It's 313 trillion worth of global debt, which is a third up in the last 25 years. This is a lot of debt. And why is this important? Because as Liz Truss found out, you can make a lot of bold decisions when you're head of state. But um, if you owe that much money to financial markets, then you need to pay attention to their reactions. The U.S. is slated to refinance around 8 trillion of their debt this year and issue 2 trillion of new debt. So that's roughly a third of their GDP that needs to be refinanced. And if you keep upsetting financial markets, and you're going to have to refinance at a higher rate, which is not very good when you do fiscal planning in the next 4 years. If markets are upset, then the US government will not have fiscal space to implement tax cuts. It's that simple. Okay, and that's the good scenario. The bad scenario is that this gets out of control. But because it's the US Treasury and the dollar, and I want to be very clear about this, yes, markets are very worried, but we're very far away from seeing the US Treasury not being one of the world's safest asset classes anymore. And more importantly, we're very far away from seeing the dollar not being the global reserve currency. Next slide, please. Now, having said that, um, as we said, governments have a lot of debt. Okay, so what does Mr. Trump wants to do? He wants less debt. Okay, one way is to lower the value of the dollar because that means technically he would owe less. The other one, for dollar-denominated debt, which is almost all of America's debt, and the second one is to reduce generally their burden of their debt. And the way to do it is to let banks or financial corporates in this particular slide, which is the turquoise line, to let banks once again shoulder the burden of creating credit. Okay, and how do you do this? You deregulate. That is why in the US there is a massive deregulatory push. The UK wants to follow, and grudgingly, the Europe will likely follow as well. Four central bankers have suggested they will. So we are seeing massive deregulatory pressures. Is that good? Yes, for growth over the short and medium term. Over the longer term, which could be anywhere between 3 years, 5 years on average, or more than that, you could see systemic risks building up. Okay, we regulate banks, we don't get financial crisis. We deregulate banks, we get growth, but we also get the crisis. It's a simple choice. Next slide, please. Now, as Ben would tell you, um, Mr. Trump wants a lower dollar, but if you run big trade deficits, i.e., you import a lot more than you export, you can't have um, a weaker dollar. Why? So look at this chart. The turquoise line is holders of U.S. Treasuries. The blue line is the U.S. trade balance. And why do those two lines move antithetically? Because if I'm China and I want to keep trading with the US, the more I trade and I have a trade surplus, the more my currency would appreciate. And there, after a point, I could not sell to the US anymore. So what do? I sell my renminbi and I buy something safe, like US Treasuries, some safe dollar assets, something that allows me to convert my renminbi into dollar assets. Okay, so that's why Mr. Trump wants to reduce his trade deficit because there is no way that he can have a competitive currency with that big a trade deficit. Next slide, please. Now, just to make this, more bring it down to earth a little bit because it's all well with the high brown notions. Okay, but at the end of the day, it's about what businesses should do. So businesses should acknowledge that a system that is often reset means that it's a system that's prone to crisis and revision. So in that system, you need to build resilience. You can't be surprised every time there is a crisis. There is going to be one every 5 or 10 years, and I think with that debt burden, you could see more macroeconomic and financial volatility going forward. So it doesn't matter even if all the tariffs are repealed, underlying tensions are there and it will not go away. This is a world that's not unipolar anymore. So companies need to build local expertise and they need to be agile about it. It used to be that we had a corporate head office that would tell all the other smaller offices what to do. That's not necessarily the case or how it's going to work going forward. A one-size-fits-all top-down strategy may not work as well because it's a more fractured world. So you need more local expertise and more empowering local agents, which can be very difficult, especially for some bigger incumbents. CFO should not be tempted, in my humble opinion, to reduce investment in AI because this is a world where margins are going to be attacked by all sides. So technology is your way out. It's not a useless expense. It's a very important R&D, and we are at the precipice of the fourth industrial revolution. It's about how we get AI to help us maintain our margins in this world rather than giving up because it hasn't worked so far in the way that we want it to. And finally, CEOs need to make sure they find pockets of stability, stable areas, or treasury officers, stable currencies stable areas where they can operate, or stable currencies where they can keep their investments at least over the medium term, and so on and so forth. Every department right now in the C-suite should discuss where is the stability found. That is the resilience theme that we keep talking about. Finally, next slide. What comes next? As we said, economic volatility and uncertainty will likely persist. Trade negotiations are on the way, and to not to put too fine a point on it, the ability to declare victory might be more important than the actual terms of the agreement. Okay, we have seen this too in other trade negotiations. So it's about a lot about it is saving face. We know that a lot of the tariffs have been repealed, but a lot of it is about saving face. So you could get good outcomes enough to repeal a big bulk of those tariffs. Still, the world will continue to become more fractious. And um, uh, Having said that, the economy has a bigger problem than markets. You see, the markets have a Federal Reserve or they have central banks in general. And if you have empowered central banks, then you don't get so much volatility. Investors will buy the dips in investments. We're also likely to see US tax cuts, Mr. Trump's big, beautiful bill. I know there is a lot of chatter about how will this pass through the fiscal hawks, but I think in the end of at the end of the day, it will likely pass. So we should see U.S. tax cuts, which could boost profits for U.S. companies. And as we said, we will see deregulation very likely in financial services, but also in pharma, energy, tech. We also see audit deregulation, which tends to affect all firms. So there is massive deregulatory push coming from the US that will likely spread to the rest of the world. And with this, I will yield the floor back to Ben.
Thank you very much, George. Insightful as always, and a lot of detail there, both on what's happening, but also some of the underlying drivers to think about. We'll pause there before we move to markets and portfolios. If you do have any questions, obviously there was a chance to submit them when you signed up. There's also a Q&A box in the bottom. So if you want to ask questions live, that's where you can ask them. We have one submitted in advance that we'll use to buy people time if you have any questions to go live. So George, this is very topical, and the question is, what would happen if Donald Trump were to fire the Fed chair?
Uh, Not good, obviously. You see, a lot of the global financial system depends on the ability of central banks to print money in times of big stress and to act independently, which means that if they see growth, heating up, they need to slow it down so that it doesn't become inflationary. If they see growth tumbling very quickly, they can loosen interest rates and help it back up. There is stabilization mechanism. Now, if Mr. Trump fires Jay Powell immediately, nothing will happen likely, but over the medium term, markets will assume that the central bank cannot perform its function of fighting inflation or stabilizing growth. And that could further imperil trust on the US dollar, which is the linchpin of the global economic and financial system. That's why Mr. Scott Bessent has said in many at many times that he does not wish to see the presidency meddle with the independence of the central bank.
Great. Thank you very much, George. We'll take any questions. We can answer any questions you might have about economics as well. It's not a hard cut-off. So I will open those up now. And the first one, I think, is going to be for George. And it's about interest rates, one of your favourite topics. George, why are interest rates so much higher in the UK than Europe when inflation in the UK is at 2.6 and it's only slightly higher than EU at 2.2? Will the Bank of England not cut rates by more than 25 basis points when the 125 basis point impact cut has been immaterial? George, what do you think?
So yes, you are looking at the inflation number, which surprised us to the downside, the latest one, but we do see inflationary pressures persisting, and the central bank is seeing inflationary pressures also persisting. So, not to put a finer point on it, I think interest rates could come down. Yes, you have a very good point. But the it's the inflation uncertainty that is the problem. You see, the central bank can't get it wrong on the downside. They'd rather get wrong on the upside. Okay, they need to make sure that people know that they're a capable inflation fighter, which means erring in the side of caution. So if they see growth uh, slowing down precipitously, we will likely see more accelerated rate cuts. In fact, that is part of the positioning change we have made in our portfolios.
Great. Thank you very much, George. Again, if you have any questions, please use the Q&A box. I'll go to one of our two questions that we have pre-submitted. I'll pick up the first one. I'll bounce the second one to George. The first one was where we think the UK market will be by December this year. And as always, timing specifics on markets over the short term is incredibly difficult. Fundamentally, to our mind, it's not forecastable. We can only look at the probability weighted general outlook. And I think, as I indicated in our markets and portfolio section, we've reduced our UK exposure given the headwinds. Now, when I showed you that chart of the US trade, you saw that valuations had fallen, but actually earnings had held relatively steady. In the UK, it's actually the other way around. Valuations have actually picked up. Now, they were at very low levels, so they still have a little bit further to go, maybe. But as we said, with valuations having come up, and as I talking about UK earnings are expected to contract this year. I think that does present headwinds for the UK. So I think the UK is likely to lag the US, just as it has done better than the US in a falling market, is likely to lag if we do see a rally. And the outlook for this year is some sort of muddle through will probably leave equities, I would estimate, in positive territory. So I think the UK may still see slightly up this year, but crucially, what I do think is that UK equities are going to lag the US equity, not least because the US has much greater capability to deploy that fiscal stimulus that George has talked about, whereas here in the UK, economic growth is a little bit tougher, and we know there is much less fiscal headroom. George, another one for you. This is on currency, pre-submitted question. George, where do you see sterling heading by Q4 this year, so the fourth quarter?
Okay, so if equity markets are unforecastable, especially over the shorter term, currencies are really unforecastable. Okay, so sorry, the short answer here is that I do not know. Having said that, if we stick to our call that interest rates could come down if inflation doesn't persist, then the higher probability event would be to see a slightly weaker pound.
Great.
But again, very, very low confidence call on this one. Currencies aren't really forecastable.
Currencies are extremely hard to call. I would totally echo that. And the final one that we have on the live feed is how long will it take? I'll answer this. How long will it take for the portfolio to make up for the gains lost over the last couple of months? I think again it's incredibly difficult to call. Investing is a multi-year activity, so being able to call how markets will move over the next few months is very difficult. What I will talk about is historical patterns. The reason that we talk about minimum holding periods in equities being multi-year, through most periods, even the global financial crisis, which was one of the worst events in markets, and certainly not comparing that this time, but even if you take those really severe market environments, it took about 3 years for equity markets, that's 100% equity, to get back to gains. Because you have to remember, equity, 5 years for the price to get back to where it was, but because you get income as well, it was about 3 years for all equities. That's obviously reduced if you're in a more balanced portfolio. So it does depend on the asset split. Those are worst case scenarios if there are fundamental problems and breaches in debt and stress covenants around the world. But other times, particularly when they are market shocks, when they're caused by exogenous events but not deep-seated challenges, and we see this periodically when you see these sharp drawdowns. Sometimes you get periods where markets fall for 6 weeks and then rally for 6 weeks, and you have these short, sharp shocks. So it really depends on how things unfold. If the US starts rolling back a lot on some of its more aggressive rhetoric, starts striking deals, as what George talked about and as I talked about, the fundamental economy is not currently impaired. So the capacity to bounce back is still pretty quick. And as you saw on a 12-month basis, portfolios are already up. So if we do see a quick resolution, the damage hasn't fundamentally been done to the economic activity yet. Trust and other medium-term factors notwithstanding, but you could see a pretty quick pullback. However, the longer that these trade tariffs and other embargoes go on, the more that damage is going to start eking into the real economy, and that could therefore prolong that point to recovery. But as always, I would say try not to focus too much on short-term movement. Avoid the knee-jerk reaction to try and pull money out when markets look like they're full, because then you're missing out on the potential upside. And stimulus and other measures mean that actually the outlook is pretty balanced overall. So hopefully that answers that. Another question has come in, and I'll pick up this one. I'll see if you have any thoughts as well, George. It's Paul's question. How can the market expect US earnings to increase so much over 2 years when there'll be a significant supply chain disruption? I'll give my view, and then I'll let George give his view. And I think it reflects a lot of what the US is a relatively closed economy, and there is still a significant amount of consumption. A lot is driven by services. There is not a huge amount of value in the goods supply chain. George might be able to give some guide, but it's a small proportion of overall GDP. And this is about company earnings. And I think if you look at earnings around the world, particularly for services, financial services are doing very well. If you look at Microsoft and some of the other software and services companies, they are able to push through price increases, and consumers and corporations are able to weather them. A lot of price increases effectively come through to consumption. They are passed through equities. What we're seeing is at the moment, companies take these higher prices, they pass them straight through to consumers. That means that they don't impact the bottom line. And, we use Microsoft example a lot of the time, but so much of the world is run on Microsoft products. If they put up their price for Windows 12%, then, people aren't going to move to another system like Linux. A lot of people are bound in, and people will grumble. And this is what we saw post-COVID. People grumble about these price rises, but there's a thing called sort of revealed preference, and consumers are still willing and able to pay for them. And if we do see these productivity gains continue to come through, particularly from businesses investing in R&D and other aspects, it's still good news for companies overall, because goods and those supply chains are very small parts of the overall economy. It's also worth remembering as well, it would be very significant if tariffs were put on at these embargo levels and kept on forever. But a lot of businesses stockpiled inventory at the start of the year in anticipation of tariffs. So I think partly it reflects the limited size of goods trade overall. It also reflects the fact the market doesn't think that these trade embargoes will be imposed and left on permanently. And indeed, both the US and China have said these current broad tariffs are probably about as high as they would go at 125 and 145% for the US and China. Those are embargo levels. Both sides have said they don't think they will persist at those high levels, and both sides are already talking about those being unsustainable and looking for deals. That's why we say we think rather than just being very high and broad, it's likely to lead to more to a more complex environment. And you're exactly right that supply chains will be disrupted. But in the post-COVID era, a lot of businesses are used to the idea that supply chains need to be a little bit more nimble. So there are going to be opportunities there as well as those risks. George, anything to add to that?
Look, I want to add something slightly technical here, Ben. We say why do markets believe that earnings will be so good? We have to understand markets don't meet around and say, okay, this is what we believe earnings will be. You have about 100 analysts, 200 analysts, maybe for the very big stocks, and you have a lot of divergence. Okay, I was just looking at the expected earnings for Nvidia. The most optimistic analyst says that they will have a dollar per share. The most pessimistic analyst says 64 cents. Okay, this is a big difference. This is 100% difference by very trained individuals who look at the exact same company. So the point I'm making here is that markets do expect better earnings, but those earnings can be very quickly revised down. So don't take anything or upwards, if things turn the other way. So don't take anything you read as markets expect as a gospel or something that may necessarily hold true 3 weeks from now.
Wonderful. Thank you very much, George. And that takes us, I think, to the end of our time. So thank you all very much for listening. I hope you found it useful. As always, the outlook is a little bit more challenged, but it is not the worst, or our base case is not for the worst doomsday scenarios. It's going to be about keeping calm, keeping informed. It's about focusing on business resilience and being open to and nimble to take advantage of opportunities as they arise. If there's anything that we can do to help you, please do get in contact. Otherwise, thank you all very much for listening, and we look forward to seeing you again next time. Goodbye.